Most agents avoid new construction because they think the builder controls everything. The financing, the timeline, the buyer relationship. That's only true if you let it be. Agents who understand builder financing end up with more control in a new build deal, not less. Here's what usually happens. A buyer falls in love with a model home. The builder's on-site rep hands them a card for the builder's preferred lender. Sometimes with an incentive attached, a rate buydown, or a closing cost credit that only applies if the buyer uses that lender. The agent, who's already navigating a reduced role in a new build transaction, doesn't push back because they don't know what leverage they actually have. Two things get lost though. The buyer doesn't shop the loan, so they may be leaving money on the table even with the incentive, and the agent loses the financing conversation entirely, which means they lose the ability to add value at the moment the buyer needs it most. On top of that, a lot of agents have a reduced commission structure on new build deals to begin with, which makes it even more important to stay relevant through the whole process instead of getting reduced to a bystander. Three things every agent should understand about new construction. 1. The builder incentive is usually negotiable in structure, not just amount. If a builder is offering $15,000 towards closing costs contingent on using their preferred lender, that number is often available even with an outside lender. It just requires the agent or buyer to ask, and to have a lender who knows how to structure the request. I do this regularly. Get on a call with the builder's rep, confirm what the incentive actually requires, and structure an offer using an outside lender that still captures it. Sometimes the incentive is genuinely exclusive to their in-house lender, but you won't know until you ask in writing, and a surprising number of agents never ask. Number 2, the construction timelines and rate locks don't match resale transactions. A production builder home might close in 60 to 90 days or even longer. A custom or semi-custom build can take 9 to 12 months. Most standard rate locks don't cover that. Builder preferred lenders often have the extended or float down lock products built into the specific timeline. If a buyer uses an outside lender, that lender needs a product that covers the actual build timeline, or the buyer is exposed to relocking at whatever rate exists when the home is finished, which can mean a materially different payment than what they budgeted for a year earlier. Number 3, construction-to-perm loans. For custom builds where the buyer owns the lot and is financing the build directly rather than buying it from a production builder, a construction-to-perm loan combines the construction financing and the permanent mortgage into one closing with one set of closing docs instead of 2 separate loans and 2 closings. This matters most for your custom build and luxury client, since production builders usually don't need it. Agents who understand these 3 things can ask sharper questions on behalf of their buyer at the model home, and position themselves as more useful than the agent who just shows up through the final walkthrough. An agent I work with brought me a buyer who'd already fallen for a lot in a floor plan with a mid-sized production builder. Builder was offering a meaningful closing cost credit and a temporary rate buydown, but only through their in-house lender. We got on a 3-way call with the builder's sales office, and I confirmed in writing that the incentive was tied to using an approved lender list, not exclusively their in-house lender. You see, most builders have more than one approved lender, they just don't advertise that. So we qualified as an approved outside lender, submitted our documentation to the builder's team, and the buyer kept the full incentive. Buyer kept the full incentive, used our rate lock extension product to cover the 7-month build timeline, so they weren't exposed to a rate change at closing, and the agent stayed primary point of contact for the buyer through closing instead of getting sidelined by the builder team, who typically handle everything once their own lender is involved. Same incentive, different lender, agent stayed relevant to the entire transaction and picked up a referral from that buyer's coworker who was also relocating to the same employer. Assuming the builder's preferred lender is the only way to access the builder's incentive. It's usually not, but you have to ask in writing before the buyer signs anything. Agents who don't ask leave that leverage on the table and lose the financing conversation to the builder's team by default. The second mistake, closely related, not reading the purchase agreement's financing contingency language closely enough. You see, builder contracts sometimes have different or shorter contingency windows than a standard resale contract. If your buyer's outside lender doesn't close within that window, the builder can, in some cases, keep the earnest money. So know that language before your buyer signs, not after. Next time a buyer is looking at new construction, before they sign a purchase agreement, call me. I'll get on a call with the builder's sales office, confirm exactly what the incentive requires, and tell you if an outside lender can capture it. That's a conversation that takes a day, and it can be the difference between your buyer keeping $10,000 to $15,000 in incentives and losing them by default. And if you're actively working with a new build community right now, send me the builder's name. I likely know their incentive structure and approved lender policy from prior deals, which means I can usually give you an answer in minutes instead of days. If you've got buyers looking at new construction, bring me in before the model home visit turns into a signed contract. I'd rather be the extra call on day 1 than a rescue attempt on week 12. Text me at 303-596-9077 or teamaronheim.com for realtors.